For the first time since the last bear market, Bitcoin has dipped below its 200-week moving average, a level that's historically marked the best buying opportunities in crypto. Across Asia, meanwhile, more than $700 billion has vanished from markets in a single morning, and the AI bubble everyone's been whispering about is starting to whisper back. Tonight, we're unpacking a market caught between two stories. Bitcoin finding support on a historically sacred line, while traditional equities, especially semiconductors and leveraged chip bets, are showing the telltale stress fractures of an overheated rally. The question isn't whether corrections happen, it's whether they stay confined to one corner of the world or if they metastasize. Hey, welcome back to Finance Graph. Today, the 200-week line, where bears turn into buyers, Metaplanet's $2.6 billion gamble in a sinking yen, the yen collapse and carry trade unwind, and South Korea's leverage trap, $700 billion in one morning plus 7 more. Let's get into it. Let's start with something you'll want to mark on your calendar. Bitcoin traded down to around $57,700 USD late last week and briefly touched below $58,000, which put it below the 200-week simple moving average for the first time since the depths of the last bear market. Now, if you've followed crypto long enough, you know this line isn't just some arbitrary squiggle on a chart. It's a level where, historically, the best entry points have consistently shown up. Every time Bitcoin has broken decisively below it, the subsequent recoveries have been ferocious. The mechanics here are straightforward. Long-term holders don't panic, they accumulate. What we're seeing now, though, is that 53% of the entire Bitcoin supply is sitting in losses as of late June. The problem is, most of that belongs to short-term holders who bought into the recent rallies. If you ask this old coin counter, that's actually the setup for something interesting. Short-term holders capitulate. Their coins float down into the hands of accumulators, and then the game resets. The wild card is timing. We've had weeks of analysts calling for $48,000, $45,000, even $40,000. The more everyone agrees on lower targets, the less likely that's where the bottom sits. History doesn't work by consensus. While Bitcoin was catching its breath, the Japanese corporate accumulator Metaplanet confirmed it had bought another 2,123 BTC in the second quarter at an average of roughly $221 million. That brings their total Bitcoin holdings to around 43,000 BTC, worth approximately $2.6 billion at that time. Now, here's where it gets delicious. Despite the fact that they were issuing new equity to fund that purchase, their Bitcoin per share yield was positive by 6.6% in Q2. Translate that. The Bitcoin they own is growing faster than the dilution from new shares. Dylan Leclerc did the math and noted that Metaplanet's debt and preferred shares were running about 23% of the Bitcoin they hold. In other words, their treasure chest is larger than their liabilities. Sounds peachy, right? Here's the catch. Metaplanet's actual equity price has cratered. It's down roughly 35% from an all-time high around $94,000 USD, while Bitcoin itself was trading around $61,000. The shares themselves have shed 90% of their value from earlier peaks. Color me skeptical about anyone claiming this is a smooth ride to riches. Yes, there's leverage embedded here. Yes, Bitcoin could double and the equity could moon. But you're also watching a company that's burning through currency exposure. The Japanese yen has collapsed to its weakest level in 40 years against the dollar, and relying entirely on Bitcoin's recovery to justify valuations that have already been carved in half. They're now only 515 BTC away from becoming the world's second largest Bitcoin corporate holder. That ambition is admirable. The path to get there is a minefield. The Japanese yen has hit its lowest level against the US dollar in 4 decades. That's not a small tremor, that's a structural shift. For Japanese investors, there's actually a silver lining in one direction. If you own Bitcoin denominated in dollars and the yen weakens, your Bitcoin position is worth more yen on paper. Over proportionally more, because you're getting the Bitcoin upside plus the currency translation. But flip the lens. Foreign investors who've been harvesting massive gains in Japanese equities now need to sell. When they convert those yen proceeds back into dollars or euros, they're swapping yen for harder currencies. That selling pressure spirals the yen weaker. The irony is that the weakness itself becomes self-reinforcing. What started as profit-taking becomes a currency crisis narrative, and suddenly the yen is not just weak, it's broken. If you ask this old observer, this is the hidden risk in Metaplanet's story. They're betting on Bitcoin appreciation while sitting in a currency that's in freefall. The hedges they might employ to offset that are expensive. The alternative is to let the exposure run naked. Neither option is particularly clean when you're leveraging equity prices on top of spot Bitcoin holdings. This morning, Asian markets saw $700 billion in value evaporate. South Korea's Kospi index dropped 8%, the Nikkei fell 2.5%, and China's Shanghai Composite shed 2%. That's not a normal Tuesday. What triggered it? Part of it is generalized risk-off. Part of it is tighter monetary policy in Japan. Part of it is a widening awareness that the AI bubble might actually be a bubble. But the real issue in South Korea is leverage. The SK Hynix Semiconductor ETF from CSLP Asset Management has accumulated $13 billion in assets in just 9 months. That's more than twice the daily trading volume of SK Hynix itself. On a volatile day, leveraged ETFs can represent up to 66% of the entire trading volume of that single stock. Repeat that, 2/3 of the volume is synthetic leverage. SK Hynix and Samsung Electronics together make up 57% of the Kospi index. Those two companies are the index. So when you have levered ETFs piling into a leveraged mega cap that's already 800% higher in the last 12 months, what you actually have is a Jenga tower made of leverage. The insurance costs, the put option skew, has risen from roughly 3% to 10% annualized in short order. And that's the market pricing in severe stress. When the levered longs start to unwind, the unwinding is accelerated by automated stops, margin calls, and more unwinding. It's not a correction, it's a cascade. And Seoul isn't insulated. This spills over. Global capital takes its chips off the table, swaps Korean won for dollars, and suddenly the Korean currency is at its weakest level since the 2008 financial crisis. The US Semiconductor Index, the SOX, has posted 87.8% gains in just the second quarter of 2026. Let me spell that out because it's nuts. The previous record for any single quarter was Q1 2000. Right before the dot-com implosion. That quarter saw 67.75% gains. We've now nearly matched that in a single quarter of 2026 without a full market collapse preceding it. Year to date, semiconductors are up more than 100%. That's not a bull market, that's a stampede. Now, the saving grace compared to 2000 is real. These aren't shell companies with .com slapped onto their domain name. SK Hynix makes actual chips. Nvidia makes actual chips. They ship them. They generate revenue. The substance is there. But substance doesn't prevent bubbles. It just makes the fall somewhat more rational. The problem is that today's leverage structure is different from 2000. Back then, you had retail speculation. Today, you have levered ETFs, options positioning, margin lending, and algorithmic rebalancing, all stacked on top of each other. A 10% correction becomes a 20% correction because the leverage unwinds. A 20% correction becomes a crash because the margin calls chain. If a shock hits, and history suggests one will, the dominoes fall in sequence. Bitcoin's not immune, though it doesn't have to get dragged all the way to $5,000 as some doomsayers are suggesting. But traditional markets, they're at maximum risk. The IMF has issued fresh warnings about the speculative nature of the current AI market. China's Railspring Asset Management, the same outfit that called the 2007 subprime collapse, has now raised the alarm bell about the current AI bubble. When an institution that caught one supercycle correctly starts using the B word again, you pay attention. The narrative right now is that AI is transformative and therefore justified at any valuation. Some of that is true. Generative AI is changing how people work. But the economic value extraction from that shift is a separate question from the price your equity is trading at. We've seen this film before. In 1999, broadband was real and transformative. That didn't stop Akamai from trading at an insane multiple that got cut in half twice over. The current crop of AI plays might be genuinely superior to their dot-com predecessors. That doesn't mean they can't correct 40%, 60% or more as the market recalibrates what. Here's the scenario that keeps me awake, not in panic, but in sharp attention. Bitcoin is sitting on the 200-week line. Asian equities just sold off $700 billion in a morning. Semiconductors are at a valuation peak not seen since the dot-com era. AI sentiment is souring among institutional watchers. Leverage is everywhere. In this environment, a shock, an earnings miss, a geopolitical surprise, a credit event, anything unexpected, could trigger a broad deleveraging across all markets. The way it would cascade is via margin calls in traditional finance, forced selling of liquid assets like equities, and then a bid-ask spread that widens as liquidity dries up. Would Bitcoin get pulled down with it? Almost certainly, in the short term. Traders are already positioned for that. The funding rates are positive, which means longs are paying shorts a premium. That's a crowded trade waiting for a prompt. But Bitcoin doesn't fall to $5,000 in that scenario, unless something far more structural breaks. Bitcoin has decoupled from equities before during broad sell-offs. The reason is simple: it's not a carry trade. It's a store of value that some investors buy into precisely when everything else is on fire. Late June, Bitcoin held up relatively well while Asian markets cratered. That tells you something. The bid below $58,000 might hold, or it might not. But if it breaks, the downside is probably more like $45,000 to $50,000, not a zero. That's the range where you'd expect systematic accumulation from the long-term crowd. Not financial advice, obviously, just the way the math tends to work. One thing that hasn't gotten enough airtime in the panic narratives is the structure of liquidity in Bitcoin right now. There's a lot of money on both sides of the tape. Yes, many traders are betting that lower lows are coming. Their conviction is so high that they've pulled a record amount of Bitcoin onto exchange order books, expecting to buy the dip. But here's the catch: that same liquidity setup can work the other way. If buyers step in more aggressively than sellers expected, that bid wall disappears fast and price snaps higher. Conversely, if the shock does hit and margin calls domino through traditional finance, that liquidity dries up on both sides. The bid-ask spread widens, volume collapses. That's actually worse than a slow bleed. It's a gap move that catches everyone off balance. The current situation is reminiscent of 2015, when everyone was sure Bitcoin was going to $1,000, but instead spent months grinding higher from $200. Or 2018, when the consensus was another leg down to $3,000. And instead, Bitcoin bottomed at $3,800 and spent a year recovering. The trades that looked obvious in hindsight were never obvious in real time. Skepticism is warranted, but dogmatism in any direction right now, absolutely certain lower prices are coming, or absolutely certain Bitcoin is safe, is just a different flavor of overconfidence. Let's cut to the brass tacks. If you hold Bitcoin, you're in a position where the next few weeks matter disproportionately. The 200-week line is a psychological and technical anchor. A hold above it and a gradual recovery would suggest that capitulation is behind us. A break below it, sustained over days, signals that the selling has more room to run. If you hold equities, especially tech or semiconductors, you're holding an asset that's massively extended and sitting atop a leverage structure that could unwind quickly. If a correction hits, the leverage magnifies it. If that correction spills into credit markets or currency markets, it contagions faster. The right question to ask isn't, should I buy or sell? It's, do I understand the leverage I'm carrying and the shock absorption I have if markets gap down 15%? For Bitcoin specifically, the historical pattern is that bear markets bottom with a final capitulation that breaks everyone's confidence. FTX collapsing in late 2022 was that event. We don't know what the next shock is, or when it comes. It could be tomorrow, or it could be 6 months away. The only thing we know is that extreme valuations and extreme leverage eventually meet. When they do, the impact extends beyond the asset where the leverage lives. That's not prophecy, that's mechanics. Here's where I plant my flag. Yes, the macro environment is stretched. Yes, leverage is dangerous. Yes, a shock could happen tomorrow. But it's also true that buying corrections is how fortunes in Bitcoin are made. Metaplanet, for all its equity woes, is accumulating Bitcoin at prices that if Bitcoin recovers even to $80,000, will look absurdly cheap. They bought 2,123 BTC in Q2 when the headlines were about crashes and recession. That takes backbone. I'm not advocating you lever yourself to the hilt and buy on margin. That's how you get liquidated and lose everything. But building a position gradually, specifically in moments when the consensus is dire, is how long-term wealth is built. The reason the 200-week line has such historical significance is precisely because it's where scared money capitulates and cool money accumulates. If you understand the risks, understand your time horizon, and understand that you can afford to be wrong in the short term, then corrections aren't catastrophes. They're invitations. The difference between a catastrophe and an invitation is preparation. If you've prepared, if you have dry powder, if you don't have margin debt, if you're comfortable holding for years, then even a 40% drop from here is manageable. It's not fun, it's not pleasant, but it's temporary. That's something the traders screaming about $30,000 Bitcoin don't seem to grasp. So, here's my read. Bitcoin is caught between two currents. One is negative, extended equities, AI bubble warnings, leverage everywhere in Asia, the yen in free fall, and $700 billion evaporating from markets in a morning. The other is positive. Bitcoin has historically bounced from the 200-week line. Long-term holders have never sold in size. Corporate accumulators like Metaplanet are still buying despite personal losses, and corrections are where the best entries appear. Neither current is large enough to overpower the other right now. That's why we're seeing sideways, choppy action punctuated by sudden moves. The next catalyst will tip the scales. If it's a shock from equities or credit, Bitcoin will trade lower, but not catastrophically. If it's confirmation that the worst is behind us, maybe earnings hold up, maybe the Fed signals slower rate hikes, maybe some geopolitical tension resolves, then Bitcoin rallies from here. And the 200-week break becomes a legendary entry point. The art right now is not predicting which it is. The art is positioning yourself so that whichever happens, you're not forced into a decision by margin calls or panicked conviction. That's not sexy. Doesn't sell newsletters, but it's the only approach I've seen work over the long game. That's the state of play as we head into the second half of 2026. The macro backdrop is tense, the technicals are intriguing, and we're playing with fire and water at the same time. If you found any of this useful, hit subscribe so you catch these deep dives as they land, because the next few weeks are going to be crucial. Next video, we're drilling into the options positioning on the SPX and what the put-call ratios are actually telling us about institutional conviction. Till then, stay sharp. This is educational and entertainment content only. Nothing herein constitutes financial advice, a recommendation to buy or sell any asset, or an opinion on what you should do with your money.